Welcome to Opto Sessions, where we interview the brightest minds from the stock market, uncovering their secrets to success. If you're looking for ideas, tips and techniques from the world's best, you're in the right place.
Hello all, I'm Ed Gotham, and today we have an excellent episode in store for you with an expert in macroeconomics, Fahad Kamal. We'll be discussing the latest stock market rally in depth, find out why this isn't just a FOMO rally, why US equities are expensive but potentially could still go higher, and finally why you should normally ignore geopolitical turmoil. Enjoy. Welcome everyone. Today I have the pleasure of speaking to Fahad Kamal, Chief Market Strategist at Kleinwort Hambros. Kleinwort Hambros is part of the private banking and wealth management division at Societe Generale. Fahad has been at Kleinwort since 2012, devising the firm's macroeconomic views and translating those views into actionable investment strategy. Fahad chairs the investment committee at Kleinwort Hambros and also sits on the private bank global investment committee for Societe Generale. Previously, Fahad worked for the US Agency for International Development and also the RiskMetrics Group. Thank you for joining us, Fahad. How are you?
Fine, thank you, Ed. Thank you very much for having me today.
It's really good to have you on the show. So to kick off, I thought, Kleinwort Hambros, what's their current view on the equity markets and how they stand? And does that differ at all globally between US, Europe? There's quite a difference in how equity prices have been sort of moving.
We are generally cautious on the market right now. We are slightly underweight equities at the overall asset allocation level. But within regions, we have a overweight towards the US, which has obviously been a good place to be for a very long time, and especially including the last few crazy months that we've had, and that remains the case. So underweight at the overall level, cautious for a number of reasons, but within the regional splits, we are long the US.
And we've seen equity prices reverse. Last week we had some some very sharp pullbacks on one day, but they pushed back towards all-time highs, especially the US equities, Nasdaq in focus there, due to the sort of Fed announcing they're buying individual corporate bonds. What's your viewpoint on the reaction to that?
Well, I mean, the viewpoint is pretty clear. I mean, you could see that markets opened up yesterday at 2% down. Really, largely continuing that sell-off that took place last Thursday. And then yesterday, you had the markets open up 2% down, very worried about news over the weekend from Beijing and from the southern states in the US, where the virus seems to be creeping back up. But of course, and this is a microcosm of the last few months, really, the Fed came in and announced on schedule that they were going to be buying corporate bonds directly. They already have been buying them via ETFs, etc. And that caused a huge fill-up. And you saw a 3% swing in markets from 2% down to ending 1% up at the end of the day. And that's really, that all that occurred within a day, but you could basically stretch that chart out to the last 3 months and it would have looked very similar.
Yeah, that's very true. And are you able to, because the Fed obviously has been doing a lot of buying of bonds to stimulate the economy, are you able to go into detail on the sort of theory behind that? Why does that have a positive reaction in the markets? I think it's related to sort of increasing eventually consumer spending as the money gets distributed through the economy. Is that correct?
Not quite. I mean, basically, look, there's a number of factors. First of all, the Fed's mandate. It's a dual mandate. One is to maintain price stability, and the other one is to maintain a full degree of employment. So that's really what they're trying to do. Now, of course, how they do that is largely through monetary policy, and obviously, given the rates are basically zero bound, the only tool they really have to influence those two main factors remains this huge amount of QE and buying of bonds, etc. Now, but the goal has always been obviously to maintain price stability and to maintain employment. Now, obviously, to do both of those things, you need to avoid a huge traitorous recession. And what they learned very well from the last financial crisis is that when you have liquidity problems in the financial markets, that exacerbates the downswing in the economy. Okay, so basically what they did is as soon as they saw markets start to freeze up, even markets for government bonds, which is unthinkable, where the liquidity wasn't quite there, where you weren't able to sell and get out or exit from from high quality bonds in a quick way. They basically flooded the market with tons and tons of buying in order to make sure that liquidity pipes stayed open. And of course, what that has done is it's hugely helped markets in general, right? Because things have been very liquid. There's been a huge buying of things like investment grade debt, government debt, etc., which has helped all of those assets rally. And eventually, a lot of that just signals risk on one end and also has a portfolio rebalancing effect on the other end, which both also then end up helping equities. But of course, that hasn't trickled down to the real economy nearly as quickly, right? The real economy is still displaying very stressed, metrics, but it would have prevented what would otherwise have been a much, much worse economic scenario. So the point is that, and I guess I'll just wrap up with this, which is that everything that they do is really meant to do to maintain their dual mandate. But in order to maintain their dual mandate, they have to avoid recessions, and they've done that by flooding the markets, which has ended up causing a huge tide of liquidity to make asset prices rise as a byproduct.
And I hear a lot of chatter about the Fed is essentially buying stocks in some way, shape, or form. If that is true, is that the sort of end of are they influencing the market too much? Something that typically is sort of sorted itself out in historic terms.
Look, they're not buying stocks directly, of course. Okay, they're not. But what they are doing is that they are obviously buying all sorts of government debt, which is bringing the yields on them much lower. That has a massive indirect impact on the attractiveness of stocks, right? So as an asset allocator, as an investor, you think about your investment landscape, and just the fact that they've made one asset class so much more attractive relatively to the others clearly has an indirect impact, even though they're not buying that asset class directly themselves. So that's part one. But part two is, if you think about where the Fed is going, they really, and this is that big Japanification point, if you think about where the Fed is going now, it's really following in quite well-worn footsteps of the Bank of Japan. And the Bank of Japan is outright buying equities within its own domestic market. Now, is that something that you would consider that the Fed will do? Well, honestly, 3 months ago or 4 months ago, if you had told me the Fed would be buying high-yield bonds directly, I would have thought that was impossible. But here they are. Now, tomorrow, could they potentially be going as far as directly buying equities from the market? I certainly wouldn't rule it out.
Do you think that's a sign of a healthy thing for the Fed to be doing that in the markets?
Absolutely not.
Too much, yeah.
First of all, everything is so distorted by these enormous liquidity injections that are being made, right? There's no doubt about it. There's enormous distortions. Things are being held up. Prices of various assets are being massively disconnected from their fundamentals because of this liquidity. And that's never a good thing. I mean, if you are a pure believer in capitalism, right, you would expect, you would just let the market take its course. But of course, that in itself has hugely damaging effects on the economy. For example, had the Fed not done what they're doing right now, which is essentially buying tons of debt and backstopping, a lot of companies out there, and by the way, this is true for most central banks, you would have seen huge amounts of bankruptcies, right? And that would have obviously been terrible. We would have been looking at something closer to the Great Depression and breadlines. So they've avoided that by doing what they're doing. But don't be mistaken. Just because we've avoided that catastrophic economic scenario, it doesn't mean that their action doesn't have huge downsides, and it will, and it does, and it will. Eventually, liquidity does not equal solvency. At some point, the Feds will have to start tapering off and turning down the liquidity that they've injected. And in that scenario, you will likely see a big spike in corporate bankruptcies. You will see, something similar to what you saw probably in the taper tantrum in 2013. Who knows really what the fallout will look like exactly. But of course, it's not going to be particularly pretty, because you right now have an entire economy and an entire financial market that's massively distorted as a result of all this intervention. And when this intervention goes, hopefully the economy is strong enough to stand on its own. But that's a very optimistic scenario. We'll see when we get there.
And so with respect to the distortion, do you see signs of a bubble in the US equity prices then?
Well, look, the biggest sign of a bubble has been valuation, right? I mean, if you think about just the metric of price to earnings, which is your classic sort of, what's going on, valuations are very, are extended. They're not cheap by any means, right? And if you think about sort of, we are at 22, 23 times in the US market right now, which is very, very expensive by any historic measure. And there's lots of other signs of froth as well. I mean, and you'll have seen sort of the anecdotal news stories recently about how the retail investors, the mom and pops, are buying, penny stocks, bankruptcy stocks. There's a huge amount of FOMO in markets. There's some evidence of euphoric, the Fed's got our back. This time is different thinking. There's lots of it. But at the same time, there's also, depending on what metric you look, some sentiment indicators would imply that there's a lot of bullishness, but others would rightly imply that there's not. It depends. The answer, as always, is that it's not clear cut. There are certainly some signs of it, but I don't think that's the whole picture.
Okay. I read a recent article, I think it was by Zero Hedge or something, saying that in the next 3 months or so, the US, a lot of this stimulation in terms of money that was being received by people on unemployment, etc. I think a lot of it stops in the next couple of months or so. I think the 1st of July, the 31st is what they said. And he said that once that stops, obviously people will start experiencing, at the moment it's been sort of delayed, I suppose, because basically pump money into people's accounts. But what do you think will be the result of that stopping? And do you see any sort of correction in the near future from these highs, particularly in the US?
So if you think about it, in the US right now, everybody is getting $600 a week from the federal government on top of the normal unemployment benefits that they would have received anywhere via the state that they live in. Okay, so all in all, $600 a week is enough to replace 100% of the average national income. Okay, the added benefits that they're getting are basically over and above what many would have typically earned. So there is undoubtedly a factor of a huge disincentive, let me put it that way, where there is a huge amount of extra income coming from not working, perversely, as opposed to what you would have earned had you been working and there had never been a pandemic. It was important for the federal government to have stepped in and done that when they did. We had obviously no idea when these programs were enacted how long lockdowns would last, how bad the pandemic could possibly get. And at the time, we literally needed to give people money in order to keep the lights on in their homes, right? That's where we were. So the program itself was very simple in its construct. $600 a week for everybody, doesn't matter, your income position, etc. And then hoping that would come in quickly while the normal state unemployment benefits would kick in, which, by the way, they were worried that they wouldn't, because there was just such an overwhelming demand. Huge, 44 million people have applied for unemployment in the last 3 months. So anyway, that's sort of the background, right? And that has obviously led now, but now that I think that the initial shock is over and much of the state unemployment machinery has kicked in, the federal government can now shut off the $600 a week that they gave on top of what would have been the normal process. And they are at the end of July, which is a good thing, right? Because you certainly don't want to, A, create disincentives in the market, and B, to the degree that states appear to be opening up for now, as where we sit right now, you would want people to get back to their normal employment and have no disincentive otherwise. So that's a good thing. But yes, what's going to happen, basically, for the last 3 or 4 months, you have a good chunk of the population getting paid more than they would have otherwise. That's led to, obviously, a lot of consumerism online, Amazon, etc. When the retail shops opened, for example, yesterday in the UK on Oxford Street, and obviously in various parts of the US earlier, you saw surges of people queuing up outside to buy, which is part of this extra income. What is very interesting is that if you look at some of the some stats on the week-on-week change in US spending by households who have received COVID stimulus versus those that have not received it yet, the majority of it was spent on savings across income groups.
Mm.
Okay, but for those who earn $75,000 or less, after savings, the biggest increase in their spending went towards securities trading.
That's really interesting.
Yeah, and that is by a factor of 93%. So if you earned under $75,000 in the UK, or sorry, in the US, you spent 93% more on securities trading in the week after you got the stimulus check than you would have otherwise without it. Now, let's be honest, these will be smaller tickets, right? These are not going to be huge trades, but obviously you add up, the vast, a huge population in the US, and essentially a doubling, 93% doubling in their securities trading, and you can see how some of the impacts that have taken place on companies like Hertz and others, where this is look a bit like free money, a bit like free chips, and when you walk into a casino, so people are a bit less concerned about it and willing to be a bit more risky with it.
Yeah, that's very interesting. We'll pick up that in a second, I think. But I'd like to swing back to just talk about yourself and how did you became chief market strategist at Kleinwort Hambros?
Sure. So my personal background is very diverse. I've had a lot of experiences. I'm originally from Pakistan. I was born and raised in Lahore. And for any cricket fans out there, that they may remember Lahore from the great cricketing days. Anyway, but I went to the US when I was 18 for university, and I graduated from the George Washington University in Washington, D.C., which just happens to share a campus with the IMF and the World Bank. So a lot of our economics professors happen to be involved in international economics. Obviously, they were working at the IMF in the day, and professors in the evening, or vice versa. And I just had an enormous love of the discipline of economics. So I graduated in economics. I was reasonably good at it. I think I was good enough to have become a teaching assistant while I was still an undergrad, so teaching younger students, etc. I graduated in 2004. Not a particularly rosy time itself, economically speaking, but nonetheless, my first job was at the RiskMetrics Group, which did a number of things, including financial analysis and really very forensic level financial analysis. What I did there was I advised large institutional shareholders on mergers and acquisitions. Did that for 4 years, didn't find it particularly fulfilling, ended up eventually at the United States Agency for International Development, USAID, which is basically the large US donor program. And it just so happened that they had a program that was starting in Pakistan, where I was originally from. I hadn't lived there in many years. So I decided to go back and take an opportunity and basically be more of a development economist. So the program that I worked on at USAID was to try to increase the exports of textiles and cotton in very impoverished areas. The basic US idea there was, if we were to create sustainable economic incentives in some of these really poor areas, which traditionally, disaffected youth have gone awry. So the idea there was that the reason why this is all happening is because they've got no jobs to go to. So if there's jobs and if there's an economic base, things will get better. That was the basic plan. We did our best. I think we did reasonably well, but the international development sector is quite an odd one. I was somewhat unenamored with it eventually after having seen it from the inside, because it really largely is it's very governmental. Let me put it that way. It's slow moving. It's not very corporate, and in the end, I'm not sure really how much good it was doing. I think that the best way to enact change is to let market forces do it. So I'm quite a capitalist at heart. So eventually I ended up coming to the UK to do an MBA, which I did at the Cass Business School. And there was a number of job opportunities that I was weighing at the time. I ended up joining Kleinwort Benson, which was subsequently merged with Hambros to become Kleinwort Hambros and part of Societe Generale. I started off as a general sort of, using my economics background as a general macro strategist, and have risen through the ranks over the years to become essentially leading our macroeconomic views and our asset allocation decisions, which has been really a wonderful experience for me. And every day is challenging. It's new. It's the world's biggest puzzle, and there's many ways to solve it, and also not solve it.
Yes, of course. And just for the benefit of the audience, can you describe what the main goals are as chief market strategist at Kleinwort?
Yeah, so basically the role essentially is probably twofold. So the first and probably much bigger part of the role, I would say 80% of the role, is to actually figure out what it is that we're going to do with our clients' assets. Okay, that's so that is something as simple as, do we want to be invested 50% in cash and 50% in equities? Do we want to be 20% in gold and 80% in hedge funds? Do we, whatever. Literally any permutation and combination that you can imagine, and why. So what I have done, along with a much wider team, is try to build a very robust empirical guidepost for us to make those decisions based on expected returns from various asset classes, risk profiles, general momentum that happens to be occurring within those asset classes, etc., and also taking a look at the wider economic backdrop. That's what I do for 80% of my day, is really try to figure out what the ideal asset allocation should be for various risk profiles, so conservative balanced growth. The other 20% of my day is probably spent defending and communicating those decisions in various ways, whether that's directly with clients, one-on-one, whether that is in wider forums, whether through our seminars, our conferences, etc., whether that's through all of our written pieces, our literature, things like this, perhaps this podcast. We have a series of podcasts of our own in-house, so that kind of thing. It's basically communicating everything that we are actually doing within our portfolios and why.
Brilliant. And so am I right in saying you pool clients' funds together then, and then there's an overarching way you choose to invest those funds, or is there different levels of risk? For different levels of risk, you had different strategies of how you would propose to invest them.
Yeah, so I wouldn't call it pooling of assets. Each
Yep.
client's assets are segregated. Okay,
Okay.
So
Okay.
and all that, but yes, there is. In the bad old days, there used to be, 20 years ago in the asset management industry, it used to be that every client was managed differently, even if they were exactly the same. So you used to have, a husband and a wife with exactly the same amount of money and the exact same risk profile, yet their portfolios would look vastly different, right?
Mm-hmm.
And there was no good reason for that, except that there was one person managing this and another person managing
Yeah.
that, and they were doing what they felt was best. So what we have done at Kleinwort Benson before, and then Kleinwort Hambros later, was to bring a lot of sort of institutional rigor to our asset management process, meaning that if we think that there's one right optimal way of managing the portfolio, that any 2 or 3 or 4 or 10 or 50 clients with the same risk profile and the same general parameters should be largely managed the same way. So we've got some overarching strategies of, and clients are largely should be in line with that, given that there's some good reason for them not to be. And there are many of those reasons, whether it's individual tax concerns, individual restrictions for various reasons, but largely minus restrictions, people should be roughly the same, which is why we do largely we've got a variety of risk buckets in-house, going everywhere from super duper fixed income, zero, very little risk, to 100% equity, which is a lot of risk, and then everything in between.
Brilliant. That's really interesting, actually. And I had a quick question here about your during your time at the US Agency for International Development. Did you have any learnings there that helped form your approach for investing at Kleinwort?
Well, probably my biggest learning, honestly, was how disconnected the stock markets are from the general economy.
Yeah,
I know it's a concept that's in a lot of vogue at present, given the fact that we've got obviously such a massive disconnect between what's happening in markets and what's happening, in the lives of everyday people. If you think about the real economy. people are struggling to get jobs, wages are, there's a huge amount of uncertainty, so how can those two things be simultaneously true? But I was well aware of that a long time ago, I guess, because I realized that for much of the time that I was at USA, so which was sort of, if you think about 2009, 2010, 2011, that period. Obviously, we had just had a traitorous recession, but the markets had started a pretty strong bounce back in March of 2009. Yet the global, and by the way, the EM, the emerging markets equities complex was also sort of within that. But the wider, but the underlying economy was completely disconnected from that. Both in Pakistan, where I was working at the time trying to put up this project, but also in the US, where I was where my bosses sat, because that's where the money was coming from, as well as in the wider world. It was an insight that has paid us well over the last 10 years or so, because really, I mean, right now, while we are in the depths of a historic recession, the economy hasn't been particularly great for the last 10 years, right? But yet we've stayed quite risk on through much of that, realizing fully well that what happens, we spend an inordinate amount of time discussing the economy, but it has a much smaller impact on the markets than you'd imagine. And what does matter, as I mentioned, is those, the economics is sort of important in a very longer regime sense. Where are we in the cycle? Are we about to enter a recession? But for most of the time, it doesn't really matter, unless you're about to get into a recession. What does matter is what the prevailing valuations are, what the momentum picture is in various assets, and what sentiment is telling you in terms of being over bullish, over bearish, or neutral. And that's what we've built our process around.
Sure. I suppose that segues quite well into this next section. Just wanted to discuss the current market in a bit more detail. You touched on it earlier on. The FOMO rally has been called by quite a number of people as a popular theory that the latest market rallies off the lows we saw back in March, and also the price action we're seeing in particular stocks have been largely driven by a huge increase in the amount of retail accounts investing in the stock market. Although there is also large mutual funds investing alongside these retail accounts as well. What's your opinion on this? Is there actually a FOMO rally going on, or is this something else? Is this just noise in the market?
So I've read various bits of research regarding, how this Robin Hood effect and the small, the Charles Schwab effect, and how many, thousands, tens of thousands of retail accounts have been opened, etc. in recent months, and people have they have got a bit more money now because of the government stimulus, as we were discussing, and they've also got more time because they've been at home. And what makes sense, you've got a bit more money and you're at home with lots of time, maybe open an online account and see. So that's the logic, okay? And the logic, but the thing is, as we know from markets, the logic doesn't always apply. It's things are often counterintuitive. Now, from most of the things that I've read, this FOMO effect by small retail investors will have had a small impact on the margins, and in particular stocks, particularly very beaten down cyclical stocks, or even some stocks that have gone as far as bankruptcy, right? So if you think about the Hertz of the world, that's sort of your poster child here. But in the main, I don't think it's had a tremendous impact on the wider market as a whole. What has, and what's caused this rally, has been basically, first and foremost, the pillar on which it stands, is that there has been much, much better news on the health front. Okay? There's no doubt about that. Until very recently, until last week, where you've got spikes in Beijing and in the southern US states and etc. The news in most of the previous major Western economies and epicenters has been much better, right? So France, Italy, UK, Spain, Germany, the US, obviously Japan and China before that, where the curves had flattened and started coming down. So that's been number one. That's been the first leg, right? That we actually managed to get the flattening effect on the curve that we wanted. That was the first leg. And then, of course, the second big pillar on which this whole thing sat has been the huge Fed action, right? There's been, I think, by far much bigger than the retail element has been the portfolio rebalancing element, of which, which happens when the Fed conducts such enormous, shock in all levels of QE, that, basically a lot of that has been recycled into risk assets on one hand. On the other hand, it's also given a huge signal to general investors who haven't even necessarily been part of the risk of the portfolio rebalancing, that the Fed's got their back, right? We've seen the last 10 or 12 years, the one thing that's proven true is not to worry about the economy, not to worry about fundamentals, but to just worry about what the Fed is doing. Don't fight the Fed. And that seems to have been proven true once again.
And so, but what happens because we're seeing equity valuations, in particular for the large sort of growth stocks, tech stocks, pull the main indices up to NASDAQ is at near all-time highs again. But how far can that run? Can that continue? Is that sustainable?
One thing that we always do at Kleinwort is to try to not give our opinions on every matter under the sun, because opinions are just that. They're just opinions. They don't mean anything. I can give you a very reasoned and articulate opinion, which can prove completely wrong, okay? So what we try to do, or what we like to do instead, is to try to gain as much empirical data that we can from history, okay? So the logic or the opinions that generally exist right now regarding this huge tech-driven upswing are that the tech companies are totally immune to cyclicality. They're secular in their growth profile to the degree that many of them have actually been helped by the pandemic, right? We're sitting at home more, we're watching more Netflix, we're ordering more things on Amazon, et cetera, et cetera. So that's been great. Now, if you look at history, okay, much of the logic was also given in 1996, 1997, 1998. That the world is going to change, the internet company. Now, please don't get me wrong. I am fully aware of the companies in 1997 being totally different beasts than the one that we've got, the big tech companies today. All I'm talking to you is about the basic rationale, right? There was a grain of truth even in 1997 that these companies are going to change the world. Therefore, you should be willing to pay more for them, right? Now, that ran until December 2000. So I'm going to give you the S&P 500 information technology sector, okay? The forward PE ratio for that sector hit 57 times in December 99, okay? 57 times. Today, we are at 26 times. So just as a historic proxy, can we go back to 57 times? Possibly. We've been there before, okay? Yeah. But I highly doubt it. One is that obviously the earnings are much, much bigger right now for these tech companies. So for the price, it would have to be, would just be astronomical if we were to go to a 57 times PE. I think that basically right now what we've done is from 2012, when we were at 12 times, to now we're at 26 times, the margin has basically expanded tremendously, right? It's more than doubled. We're paying more and more for these earnings. And as amazing and incredible and wonderful companies that they are, I don't think that it's prudent or wise to be buying them at 26 times, because how much further can they go? 30 times? 35 times? To answer your question, at some point, the fundamentals have to be reflected.
Yeah.
Right? In any short period of time, or even for a very long period of time, you can see a disconnection carried on. But at 26 times earnings where they sit right now, I don't see them doubling again, as they have done in the last 5 years.
Yeah.
Now, don't get me wrong. I think these are incredible companies. And as I said, there's a grain of truth in everything, right? They are very resilient. They are very, robust to the world that's coming. But yet there's also lots of underappreciated risks. They're priced for perfection right now. But nobody has taken into account the fact, or markets certainly seem to be very complacent about the regulatory risk, okay? So the number of government regulations that exist on the tech sector right now are non-existent compared to banks or industrial companies or whatever. This can only go in one direction. right? The growth profile is obviously slowing down. If you think about, the total daily active users of Facebook, for example, it used to be that they were growing at 50% per year in 2011, 2012, when we were at 12 times earnings, okay? And now, Facebook is growing at sort of, its number of users are growing at 6 or 7%. And we're paying 26 times for it. So, like now, of course, Facebook is probably an older technology. Instagram is probably the newer thing. But you get the point that I'm trying to make here, right? Is that we are really, even these companies will eventually see a slowdown in growth, and that may be sooner than later. But we're pricing in true perfection, which for which there's many things that could go wrong.
And so I can take the assumption that we're saying sort of US equities generally, or tech in particular, are expensive in the US at the moment. Is that what you're sort of implying? Or
well, what I'm saying is that the US market is generally more expensive than any other market, right? So even if you just were to look at the US equity market on a pure PE basis, at the market as a whole, it's somewhere like 22, 23 times. And if you take the Bloomberg Tech Index, that's somewhere like 26, 27 times. And if you take just your FANG stocks, they're trading at 34, 35 times. So it's expensive all throughout. It's expensive at a sector level. It's expensive at a these tech darling level, and it's definitely expensive at the market level. But valuation is very nuanced, right? As I said, it's not a clear cut case. Given the fact that interest rates are so low, there is obviously you're discounting future earnings much less, and therefore you should be, in theory, be willing to pay more for that. Okay, fine. Also, all the alternatives are abysmally priced, right? I mean, if you think about what the earnings yield on bonds is right now, it's way worse than it is on equities. So relatively speaking, these are equities are more attractive. So it depends on how you look and measure valuation. It's certainly not clear cut, but nonetheless, on an absolute basis, it does give you some cause for caution is all. Now, as I said, we are generally underweight equities at the overall level right now, because we still think that there's a lot of complacency in markets. There's there's big downside risk here from current valuations, from disconnection with the wider fundamentals, etc. Yet, of the equities that we like, we're largely skewed towards the U.S. because we also do believe in the tech story being somewhat resilient. But we're not making an outsized bet on tech. We've got a somewhat of an overweight to that industry, but we're more recently have been positioned towards seeing a cyclical recovery, which we think will come. At the end of the day, it's really much more important for us to be, whether we're underweight or overweight at the overall asset allocation level, than really what we do internally to some degree, because over time, over the long run, that's where your sector allocation, that's where your returns will really come from. And we are looking to add back to risk if the recovery that we see right now is confirmed, if momentum carries on being positive, and if the earnings do sort of hopefully catch up with where the prices have already preemptively taken them. Right now the prices have gone up, assuming that the earnings are going to follow. Should these factors converge, we will look to increase our overall risk towards equities.
Yeah. And so what metrics are you looking at to support the market recovery, which would then make you more risk on in terms of assets in equities?
Yeah, so as I said, first of all, we obviously take the two powerful factors that are existent right now are important, and we see them, right? There's definitely been a better news on the health front, and there's a huge amount of Fed stimuli, central bank stimulus. Those are important. But in order to participate more fully, our process, which is, as I said, we look at the economic from a regime level. In aggregate, the global economy is suffering its deepest recession since World War II. And according to World Bank's latest forecast, we're about to contract by 5-6%. I mean, unthinkable numbers. When we see the second derivative turn around, so when the rate of growth actually starts to come positive, which hopefully might come as soon as Q3, that will be a signal for us to enter risk. Because that may, like I said, there's a huge disconnect between economies and markets in any short run period of time, but regimes are important. We want to be out of the recession regime and back into a recovery, expansion, or slowdown. Those are all okay. We just want to be out of the recession. So that will be an important signal for us to increase risk. The other part of our process is called VAMOS. So valuations, momentum, and sentiment. So valuations, for equities, it's the largest source of risk and return in our strategies. They remain very challenging in absolute terms. The U.S. equity market at 23 times is the highest it has been since 2002. That's expensive. But with rates zero, that there's a case for a higher than usual tolerance to valuations. But here, we're very much looking to see if the earnings picture becomes solidified and earnings growth is once again the derivative there changes as well towards growth. Momentum is, even at this point that we're sitting here right now, in spite of the recent surge in equities, momentum has been, we're still in negative momentum. Now we watch and follow momentum really closely because, as I said, markets don't have to follow any fundamentals. The economic regime can be poor, the valuations can be expensive, and markets can carry on going. So we follow that very closely as well. At the moment, but we look at that on a 10-month moving average basis, very slow moving. On that basis, it's still in negative momentum at the global equity level. Should it tip into positive momentum and be sustained over the course of a few weeks, that for us will also be another signal to get back in, but we're not there yet. And our final bit of our process is sentiment, which we look at as a contrarian indicator. So markets are too over bullish, we're quite risk off, and markets are too fearful, we want to be risk on. Right now, we look at a number of metrics, we're somewhere in the middle. As I said to you earlier, there are some elements of bullishness and some of bearishness. We're somewhere in the middle. All in all, if you look at the totality of our process, 3 of our factors are cautioning us, are telling us to remain underweight, which we're taking very seriously. But if and when those change, might be as soon as a few weeks, might not be until who knows when, we will change on the basis of our process, not on the basis of our opinions.
Mm-hmm. And on the flip side, what do you consider the greatest risks to maintaining these current levels in equity prices? What are the greatest risks to them in terms of news that's coming out, etc.?
Yeah, well, look, as I said, the two biggest factors of this rally have been a much better news on the health front and much better news on the Fed, in terms of just huge liquidity. Now, if either of those two things is going to be brought down, you're going to see a huge rally, because right now markets seem to be pricing in a perfect exit from lockdowns. Okay, they're pricing in a Wuhan exit, where if you go to Wuhan today, you have 80% of the people or traffic back on the roads, and you've got bars and restaurants that are open, and people are in their offices, etc. And that's what markets seem to be pricing in for New York, for London, for Madrid, for Frankfurt, etc. Should what happened in Beijing become bigger and deeper and wider and bring some pause to the Wuhan proxy that we're pricing in, that I think will be cause for big downside risk. Now, on the other side, as you mentioned earlier, I don't think liquidity is going to go away anytime soon, but the fiscal spending taps look like they're going to be closed. So in the UK already, the Chancellor's announced that the 80% backstop will basically be tapered off starting now, and it'll be gone by October or whatever it is. And in the US similarly, right, where already that $600 extra per week is going to be gone at the end of July. So we'll see what impact that has, and those are some of your big downside risks. We'll see, in addition to the